Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning, folks. Welcome to The Bigger Picture, and we've got quite an interesting start to the week for local investors. They now have the opportunity to access a broader range of companies listed on the Singapore Exchange, and this follows the launch of new indices that track the next tier of large and liquid mainboard companies beyond the 30 constituents of the Straits Times Index. And this also comes as we head into the final quarter of 2025, which is shaping up to be a pivotal one for global markets, with the Federal Reserve kicking off a new rate cut cycle. So what does that all mean for investors as they navigate both opportunities and risks in the months to come? Helping us out this morning, Vasu Menon. He is the Managing Director for Investment Strategy for OCBC Bank. Vasu, good morning. How are you doing this Monday?
Good morning, Ryan. I'm very well, thank you.
Great to have you on the show, Vasu. So on the front page of the Business Times, we've got a new product from the SGX. In fact, two new variants of the new iEdge Singapore Next 50 Indices, which will cater to investors who want to get into what's beyond the 30 STI constituents. Walk us through your takeaways from what you're seeing from here.
Well, I think this is a very positive move. It's part of the SGX's move to, create a more vibrant stock market ecosystem. And this is still work in progress. This is part of the initiative to develop the Singapore stock market, to develop capital markets in Singapore in line with the MAS's, the Equity Market Development Program that they announced some time ago. So this is still work in progress. I think what this indices will do, it will basically, number one, raise the visibility of many of these companies, especially the mid-cap companies. I mean, so far when you talk about the Singapore stock market, the STI has been getting a lot of visibility. But I think these indices, if they are properly marketed, will raise the visibility of small-cap companies because, the companies that are selected have been selected very carefully based on liquidity, based on, investor interest, minimum market capitalization, daily turnover, other factors. And it's a rule-based system, which results in these companies being included. So kudos to these companies. Clearly, retail investors look at these indices, look at the companies in these indices, and, clearly this will inspire a greater deal of retail confidence and also institutional capital, into some of these companies. So, it's part of a jigsaw puzzle that's still playing out. It's still work in progress, as I said. The index on its own is not going to drive interest in these companies. I think more has to be done. I think you probably have to see ETFs being launched, index-linked products being launched, marketing of these indices taking place, engagement between investors and companies in the indices, engagement between SGX and companies in the indices. And, all this will hopefully inspire other companies that are not in the indices to, do something about unlocking shareholder value, moving up the ante and, trying to be included in these indices as well, because these indices will be reviewed every quarter. So this is a safe move. It is not a 100% game changer, but put it all together in the last few months, what the SGX MAS, I think it's overall the right direction. We're headed the right way, and continue doing this. I think there's a scope for the Singapore stock market to, see further upside in the coming years.
Yeah, that's right. Singapore markets and Singapore stocks in particular have been hitting new highs in recent weeks. So this new index will include names like ComfortDelGro, Centurion, WeHer, Digital Core REIT, Nanofilm Technologies, giving a diverse mix of companies across different sectors. So lots to look forward to there. So on the topic about investing in markets right now, what is OCBC's approach heading into the final quarter of the year, especially when you look at where we are when it comes to the rate cut cycle?
Well, we are relatively positive on the outlook for the markets, not just the next 3 months. We prefer to look out over the next 12 months, 18 months with more medium-term investors. And I think, the rate cut cycle, if you look at it historically, it's helped to trigger more upsides for the markets. So the Fed has done one rate cut. It's talked about two more in October and December, and possibly one more in the first quarter of 2026. Who knows, there could be more depending on how the labor market and the economy does. But, typically if we look at history, when the Fed cuts rate over the next 12 months, the markets tend to do relatively well. So we are sanguine on the markets, but we don't think that it will be a straight line climb. As we have seen so far in this bull market cycle and so far this year, the markets are very bumpy because you've got so many moving parts, so many things that are changing at different times. So investors must expect the markets to be volatile. There will be drawdowns from time to time, but the trend appears to be one that is still positive, headed higher over the next 12, 18 months.
Okay, talking about where things are going in the coming months, we have tariffs still to be resolved. How much of a drag is that being priced into the markets?
Well, I think to some extent it's been priced in because U.S. tariffs have gone up from, 2.4% to close to 20%. They've almost gone up, tenfold. And so I think investors have time to digest it, internalize it. It will impact economic growth to some extent. It will impact inflation to some extent. But, as long as the impact is not catastrophic, it is not so significant to scare investors, I think, the markets will be able to go past the tariffs, focus on other factors. So, of course, it remains to be seen. I think investors are going to watch economic data, earnings data, what companies are saying about the tariffs in the coming months. But so far, we've not seen inflation numbers bump up in a big way. We've not seen economies fall off the cliffs. And I think that's good because historically, Fed cuts rates, no recession, stock markets typically tend to go higher. As long as we don't see a recession from the tariffs, I think that's good news.
Talking about data that's to come, we've got on the table this week the PCE Index, the Personal Consumption Expenditures Index. We also have the Q2 GDP numbers, the third and final revision. How critical are these data points to informing where the Fed is going, especially when you talk about how the Fed is starting to look more at the labor market?
That's right. So the Fed is looking at the labor market, but I'm sure the Fed is keeping an eye on these numbers as well. The GDP growth numbers, according to consensus, it will come in at 3.3% for the second quarter. But remember, this is the third revision. This is not a new set of numbers that are being unveiled for the first time. They're the third revision that are taking place for these numbers. And so 3.3% growth in the second quarter, that's rear view mirror. I think what investors are more interested in is, I think, what is going to happen in the next 2 quarters and perhaps the first half of next year. And we see a slowdown taking place on that front, probably quite a significant slowdown. Economic growth going down to 1% in terms of growth, but not a recession. As far as the PCE index is concerned, I think consensus again shows that, core PCE inflation rate is going to hold steady at about 2.9%. It's not going to come down. It's going to hold steady at about 2.9%. That's what the consensus is saying. And if that plays out, I think that's relatively positive. It means that, inflation is not going gangbusters and heading higher. And that allows the Fed to focus on the labor market and try to remedy the situation in the labor market through rate cuts.
Yeah, talking about going gangbusters, we could use that phrase for gold prices because it has hit new highs in recent times and year-to-date up over 40%. At current prices, Vasu, is it still looking attractive to you at this level?
Well, Ryan, our philosophy is this. Make sure that you invest in gold within a diversified portfolio. In other words, when you invest in gold, keep your allocation at close to maybe 5%, 8%, that sort of thing. Don't put all of it into gold. Gold is an insurance policy. We see more upside for gold. We see gold heading towards, $4,000 an ounce, close to that. It may even cross that level, depending on how geopolitical factors come into play. A weaker U.S. dollar, questions about Fed independence, all those could actually, and also Fed rate cuts, could actually play into a stronger gold price. Gold is now emerged as a distinct asset class, and there's clearly a story behind that rally, and that story remains, and we see more upside for gold. We think investors should have some allocation of towards gold in their portfolios.
All right. Gold now at $3,700 an ounce, and on the month it's up nearly 10%. We've been in conversation with Vasu Menon. He's the Managing Director for Investment Strategy for OCBC Bank. Vasu, thanks as always for your time and insights.
Thank you for having me on the show, Ryan.
Great having you on. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.